Hello and welcome. You're watching KYC. I'm Harsh Saita, and it's a great time, if at all, if you get to invest in a really good turnaround. And just about any time is a great time to invest in a turnaround. And today's candidate is one of those. And we've started to see an uptick in the stock price. In fact, the stock is a 2.5 bagger in the last 3 years. And the stock we're going to talk about today is JM Financial. And the person we're going to speak to today is Digant Haria. He's obviously one of those who has written about JM Financial in a large fashion on his blog. And his blog was the key trigger on the stock moving as well, at least over the last couple of weeks. And the stock over the last couple of weeks has done very, very well for itself. So here's what I really want to know. JM Financial, in terms of a turnaround, they're exiting certain businesses. And they're exiting businesses in the lending space. When you exit businesses in the lending space, you will typically start to recognize credit losses. How much of that, how much of the credit loss has already been booked? What is the comfort on the current book and on recoveries? It's a larger book size in relative terms. Approximately 3,000 to 3,500 crore is the business that they are exiting. Okay, so how much of that can they garner in terms of recovery? How much will they be recognizing on their profit and loss account? The second one, how likely is the recovery on the wholesale as well as the ARC going to be at 4,000 crore? Because that's the value which Digant has ascribed as part of his valuation. And we will talk about this as part of the valuation metric in our metrics as well. How quickly will the recovery happen is the other piece. Timing of the recovery is crucial. The quicker the recovery happens, the better it is, the more the certainty. The more it's pushed, the worse it gets. What is the risk on the retail housing book? Because that book, they're going to continue to grow. In fact, they've guided that retail housing, they will double the book size by FY27 from the current book size of 2,800 crore. That's a large and tall ask. Can that also happen? And what's the risk like? What do they do with the balance book? They've said that they'll double it. And where to from there? What's the comfort with regard to asset quality on retail? That's all that I want to understand. Now, in terms of the merchant banking business, the whole point of doing lending is to try and leverage the balance sheet, all the cash flows coming into the balance sheet from the merchant banking business, and thereafter lend. Now that they're withdrawing to a large extent from lending, what does the merchant banking business do in terms of risk? Mind you, it's a cyclical business. We have seen that between September to maybe March, April, or even May of this year, we've hardly seen any IPOs. It automatically creates a drag in the business. Can that business continue to sustain in terms of growth? And what's the other lever that it will rely on in case of a slowdown in the merchant banking business? Where do they invest the cash coming in? They've also suggested that they will do payouts, buybacks, dividends, return money to shareholders in a big fashion. So is that what it will happen, or will they invest in a newer business? And therefore, given the multiple moving parts, how do valuations look and how do they stack up? All of this we'll try to break down with Digant Haria, who's the founder of Green Edge Wealth, I beg your pardon, and he will be joining us later today. Now, let me quickly talk to you about the company first. Try and give you some context on what JM Financial is all about. I'm going to start off with when it was incorporated way back in 1973. It was incorporated as an equity broking firm and was also doing investment banking. Nimesh Kampani saw a huge opportunity in Indian capital markets, bringing what foreign firms used to do in a domestic market, in domestic fashion. And that is what he wanted to really tap into back in 1973. And here's a broad glimpse of the journey. In 1980, it became the first company to introduce fully convertible debentures in Indian capital markets. Even I was surprised by the number of firsts that JM Financial has clocked over, I don't know, the last 40 years. Now, let's talk about 1986. It engaged in the business of stock broking and securities back in 1986. It introduced equity warrants to the Indian capital markets between 89 and 94, listed on the Bombay, Ahmedabad and Delhi stock exchanges, introduced deep discount bonds to the Indian capital markets, managed 4 transactions in excess of 100 crore back in the day. That's a large amount, 1989 to 1994 we're talking about, which was unmatched back then in the Indian markets. It's the first private sector mutual fund, and it commenced operations in the 90s, in the early 90s. In 1999, it did a joint venture with Morgan Stanley, and this is in areas of investment banking and securities business. It later on went on to break up its JV, but we'll come to that. Between 2002 and 2006, here's what it did. Managed India's first IPO through book building. 3 firsts for it. First Indian dual tranche FCCB, which is foreign convertible bond issuance. First $1 billion IPO and first conditional IPO. Did all 3 of that. And thereafter launched a private equity fund between 2002 and 2006. This is. Let's talk about 2007 now. It's separated from the joint venture it had entered into with Morgan Stanley, continued to lead the Indian investment banking financial services industry as a 100% Indian company, and launched a real estate fund as well, which it still continues to operate. Let's talk about 2008 to 2012. Commenced the ARC business, expanded operations in the fixed income business. Just try and understand how deep it is with regard to its capital markets foray. 2012 to 2017, it received a license for housing finance from the National Housing Bank and commenced the SME business. Also, between 2016 and 2018, it started its wholesale lending business, which is the one which has caused some bit of discomfort, or rather a large bit of discomfort, to the financials over the last 5 years. And we'll pick and we'll try and understand all of those. Now let's talk about the business as of today. What does it do? Its business can be broken up into 4 parts. The first one is the capital market related businesses. Investment banking, broking, and both retail broking as well as institutional broking, wealth management as well as asset management. Core fee-based business. Now let's talk about mortgage retail. This is a business which is around a 2,800 crore AUM business. Currently does affordable home loans, small loan against property, and gives loans to educational institutions. The third is the mortgage wholesale business. Builder loans, large LAP, early stage financing and structured financing. This is where the problems lie at this point. All the NPAs currently sit here, or a large part of it. Then there is ARC, which is asset reconstruction. Distressed credit, which they purchase and then they try to conduct recoveries. Not happening at this point. Then they have SRs, which they have to liquidate. And then they also ventured into turnarounds. Those are the things which are really not working for it. This is where the company is actually losing money, and this is what they are likely going to avoid doing going forward. So let's understand the revenue breakup under each of these. And I've broken this up. Right, you have asset management and investment banking, which constitutes, if you just add up, 67% revenue FY25, 61% FY24, just about 60%, just maybe 53, 55% in FY23. So it's gone up gradually as a percentage of the top line. Mortgage lending has actually come down. And look at the other segment. That may just be completely ignored, but broadly it is this which is contributing to the top line. Now, this is the revenue contribution, of course. And it's again important to understand, because we've understood the businesses and now we've understood where the revenue is actually coming in from. So, now that we've understood the full business as a whole, let's talk a little bit about the metrics. I'm going to start off with the income statement, thereafter look at the balance sheet, We won't look at cash flow here. We will look at asset quality and return ratios. Thereafter, we'll look at street cred, shareholding, valuations, and we look at outlook. Outlook because it's a turnaround, mind you. So you want to look at what is it that they're changing going forward. I want to start off with the income statement first. And again, you'll see interesting nuggets and you'll want to understand how this turnaround is working. First, you look at the income statement, looks like a very uninspiring set of numbers, right? And therefore the thumbs down. Look at the top line, look at the operating profit, which has been calculated by Chinmay, who's the analyst. Provisions, which is the credit cost number at just about 7% and on a very, very high base. Look at that provisions number versus the PAT number. It's a 400 crore provisioning which is being done on a 800 crore profit after tax in FY25. Nearly 600 crore of provisioning done on a 400 crore of profit after tax in FY24. Clearly not looking good, right? And it is the problem with regard to credit costs, which is impacting profitability. Let's now flip over and look at the credit cost number over the last 4 years. And you'll notice the same trend. Look at the credit cost in FY23, it was low. FY24 was elevated, FY25 is elevated. Do we have the FY22 number as well? Because that number stood at 350 crore versus the 770 crore profit after tax. And that kind of caps off all the 4 years of credit cost and profit after tax. Now let's talk about profit contribution. And this is where it becomes very, very interesting. Look at the contribution of two pieces to profitability. Look at asset management and look at investment banking and their contribution to profitability. 80% in FY25 contributed by investment banking and asset management. Mortgage lending just 13%. Look at it in FY24, look at it in FY23, and what you will realize is a large chunk of the top line comes from these two, and the profitability, a larger chunk of that comes from these two. So it's basically the drag is coming from the lending business onto the profitability. Clearly going away from lending business makes sense at this point. Now let's talk about the balance sheet for a little bit. And I'll be quick about this. Healthy amount of equity compared to the borrowings, given that it's a retail lending business, even going forward, look at the AUM of the retail lending business around 2,800 odd crore, right? Now let's quickly look at, so a neutral here. You want to see improvement with regard to the way in which at least the AUM grows in the retail lending space. And we'll wait and watch as to how that growth comes through. But the guidance is 6,000 crore of retail AUM by FY27. That's a tall ask. Let's talk about asset quality now. The GNPA and NNPA ratios reflecting on your screen. Again, uninspiring set. The GNPA ratio is at 12%. The NNPA ratio is at 2.5%. Not looking good, right? And therefore, we've given this a thumbs down. Let's talk about return ratios now. Look at the erratic nature of it. 7.5%, 5%, 9%. Single digit. Not good enough for an Indian capital market play and financial conglomerate, which is why it gets the valuation it gets. And therefore, we'll give return ratios a thumbs down as well. Let's look at street cred though. The turnaround seems evident. Last 1 month, 18% higher stock price. 3 months, 64%. And 1 year, 75%. Clear thumbs up with regard to the performance that it has done with regard to shareholder returns. Fantastic returns given. Now let's talk about valuations before I look at outlook. Look at the price to book of this one. Around 1.6 times is the price to book. It trades at around 19 times price to earnings. And if I were to just pull this a little bit further and try and analyze it a little bit in more granularity, the market cap is around 15,000 crore. And this I've picked up straight from Digant Haria's blog. Let me be very honest, I've just copied his blog. Around 15,000 crore is the market cap. Recovery from lending plus ARC is expected to be around 4,000 crore. Based on fair value, the retail lending business should be worth around 1,500 to 2,000 crore. I've taken 2,000 crore as the number. 2 to 3 times price to book. And investment banking at 10 to 12 times earnings is roughly placed at 9,000 crore of earnings. Basically, it's the drag from investment banking or from the lending business which is being caused, or which is the impact on the valuation, which is impacting the valuation at least at this point. If that were to change, and that is changing, this may well be up for a re-rating. Hence, this becomes very interesting. Let's look at shareholding as well. And it's a closely held company, 56% interest by the promoter within the company. And you're looking at FIs which hold around 17%, DIs 7%, and public just a shade short of 20%. We've given this one a thumbs up as well. Quickly on to outlook and what to expect and what the commentary from FY24 year end, which was the turnaround commentary, seems to suggest. They will exit the less profitable businesses, wholesale and ARC. Businesses exited have been well provided for. They're entering the loan syndication business instead, and that will contribute to top line as well as bottom line. They aim to do balance sheet light businesses, focus on ROE and cash flow, focus on fee and commissions, and they are focusing more on the retail mortgage AUM of 6,000 odd crore by FY27. Buybacks and dividends will be a focus area to return shareholder value. All of this is positive if they are able to play it out the way it does. But there are still some downside risks, and we highlighted that at the start of the show. And let me bring in Digant Haria, but before that, very quickly, how the KYC rating stacks up on this one. Let's quickly pull that up. Yes, we have that. So clearly not looking good on any of these metrics. But mind you, in turnarounds, you have to look at what's going to happen going forward. And a lot of that has already happened in terms of stock price action. Is it still something that would interest a buyer or not? And what the downside risks are? Let's quickly explore those. 4.5 on 8 is our KYC rating. Digant Haria joining us, founder Green Edge Wealth. Digant, great having you. And you know, I was going through both your blog posts, extremely informative. I want to first start off by understanding what the downside risk to exiting the current business is. Do you believe that this 4,000 crore of recovery can happen without turbulence?
Yeah, hi. See, whenever, the business pivots, or, whenever there is a turnaround, so there is an old business which has to run down and close. Then, the new businesses take off. So I think last year, Harsh, was something that the old businesses were running down, and which is why, in your presentation, you showed that the credit cost or the provisions are high, and the NPAs are high. It's just because, whenever a loan book is running down, the NPAs optically look higher because, your denominator is also shrinking very fast. But I think, this year you will see that, they have done all the provisions. So this year, actually, there could be a lot of write-backs because, their NPAs are backed by land and projects. It's not as if it's a retail loan which will never come back. So I think there could be a good amount of write-backs also. So whatever pressurized their earnings in the last 3 years, I think in your slide you showed credit cost of last 3 years. I think we'll actually see the reverse of that in the coming 3 years. So what was a headwind then would probably become a tailwind over next few years because these projects will see the light of the day. So the past business, I think whatever pain had to be taken has been taken. Now those will also actually start delivering some better numbers. Obviously, the past business runs down and they will create newer businesses which are not as balance sheet heavy. In newer businesses, that 2-3 years of clean runway, there will be no NPA problems. There will be just fee income and interest income coming along the way. So I think the numbers will start looking very, very different from this year, which is FY26. So that's the opening comment, Harsh.
Sure. Let's talk about why they went into lending in the first place. What's your rationale? And is it to a certain extent also to insulate the business from the cyclical nature that merchant banking and fee-based kind of businesses generally face in terms of downside? Is it to try and level off that risk? And doesn't this decision open the business back to the same risk that they faced when they went into lending in the first place?
Well, that's a very good question. So see, if you remember the Lehman crisis, so this 2003 to 2007 was a party time for the Indian stock markets. And, then all the broking stocks, be it Edelweiss, Motilal, JM, everybody became 10 times, 15 times in those 4 or 5 years. But then came that Lehman crisis, the global financial crisis, and by 2009-10 their incomes plummeted by say 60-70%. So it was in this 2010 that a lot of these guys decided that we have to try and go to new businesses. This just fee income and broking income is not enough. So everybody chose different paths. Like Edelweiss also took the lending path. Motilal Oswal only ventured into housing finance, but they ventured into asset management. So they started this Motilal Oswal Mutual Fund and PMS. And similarly, if you look at JM, they decided to enter the lending and the ARC business. Now, if you go back to 2011-12, lending was at the nascent stage. The public sector banks were banned from doing real estate lending. And then, that is where JM saw the opportunity that, if banks are not being allowed to do this by RBI, the NBFCs will see a boom time. They actually saw a boom time between 2013 to 17, and that is a time when these Edelweiss, Piramal, India Bulls, JM Financial, everybody did really well in the lending business also. So at that point in time, everything was going right. But then, this sector itself got hit by so many things. First we had demonetization, then we had RERA, which came in, then we had the ILFS crisis, and then we had the COVID or the pandemic. So, in 4 years, there were four big events which actually broke the back of the whole real estate industry. And even very, very conservative players like JMC, JM was the least hit in all of this. You look at Piramal, you look at Edelweiss, they had to do so much to come out of the crisis. But JM obviously just had to go through some losses, but nothing compared to their strong balance sheet. But the cycle was so bad, Harsh, that even a conservative player like JM had to take a hit. Then regulations also changed after 2020 in such a way that this is no longer a viable business for any NBFC to do it. Only HDFC Limited used to do it, but now it is merged with a bank. Now they'll also not do it. So this whole real estate wholesale lending is becoming more and more the forte of these, private equity kind of funds and, private credit market, and not the listed NBFCs or banks. So I think it was a natural cycle. Now you ask me that if they are going to exit the lending business, won't they again face the same problem of being too dependent on the stock markets or the capital markets? Now the answer to this question is that, see, they have seeded three new businesses, right, which they are not shutting down and which they are growing. So one is a wealth management business, second is the mutual fund or the asset management business, and third is the affordable housing finance business. So I think all these three businesses have now, almost 6 years. Housing finance has 7 years of history. Wealth management has 6-7 years of history. Asset management has 3-4 years of history. So I think these businesses are much lesser cyclical compared to the stock markets. So I think whatever they lose out of that lending, that will be made up here. And also in the lending business, they are not completely getting out. Like, they are getting out of the old format, which was you lend for 5 years, 7 years. Now they will enter into small deals, which are 6 month, 12 month, 18 month. Because see, let's not forget that deal making is the DNA of JM Financial. They have been the deal makers of India. Whether it is M&A, whether it is IPOs, whether it is QIPs, and all these different kind of structured products. So I think they'll continue to do that. But now they will earn more of fee income and less of interest income out of that. That is their ambition, and I think that is precisely the DNA of JM Financial. So I think that the bad, last 3-4 years, that the difficult part is really over. Now it is how well they can scale in these new businesses.
Sure. So Digant, now I have just 3 minutes. I'm going to quickly try and do a rapid fire so that I can cover as many questions as possible. What's the risk like on the retail book?
Right. So retail housing finance, I think the risks are extremely low. They have built a model where they source their own loans. So I think this is a growing space, a very hot space. I think this company itself can become a 3,000-4,000 crores or 5,000 crore market cap by 28. So this is actually a high potential. I don't see much risk in this business specifically.
And can they grow at the guided 36% CAGR? Because they're currently at 3,000, they're gunning for 6,000 by FY27.
I think it's okay if they do 25% also. See, 35% may be aggressive, but it's okay if nothing, hell does not break loose if they grow at 20-25%. And I think the they have set up the infrastructure. Now they'll grow. So I just feel that, maybe if not FY27, FY28, they'll reach 6,000 crores. At least that is what we are building in.
Got it. And with regard to the top line, may not be the best way to look at it, right? Digant, there's a book which is contracting. Therefore, top line may not be the best way. What is it on the bottom line that you're looking at in terms of compounding? Because you'll see a lot of the line items go away. Like, for example, credit loss being the biggest line item will probably go away entirely over the next 2 to 3 years. What's the bottom line estimate that one can expect in terms of compounding over the next 2 to 3 years?
So I think, see, last year, like FY25, they did around 800 crores of profit. I think you add, say, 150, 200 crores to that just because of the credit cost. We spoke that there could be write-backs in the old business so that credit losses will be very low. So maybe, 1,000 crores of base profit. And after that, you can have a 15-18% kind of compounding because, see, all these affordable housing finance, wealth management, asset management, investment banking, all these businesses in India are growing at 15 to 20%. So according to us, 1,000 crores becomes the base number for profit for JM Financial from this year. And above that, you can actually see 15 to 20% kind of compounding playing out. So that is the base case which we are working with. Obviously, we need to see how they deliver over the next 12 months. Harsh.
Okay. Digant, 20 seconds. Downside risk, if any.
So downside risk, see, whenever there are sharp corrections in the stock market, obviously, this stock will correct because there is a perception their incomes will go down. So there could be interim volatility, but
Sure.
long term really looks clear. Yeah.
Excellent. Thank you so much, Digant, for coming in, speaking with us on KYC today. And viewers, completely out of time on this one. Thanks for tuning in. Stay tuned to NDTV Profit. More action on the other side.